All right, highlight for today, we had a five-tool player. If you're not familiar with baseball, five-tool player could run, could hit, could throw, hit for power, all the rest. What we had up on the highs was, and I want to explain this because, number one, it doesn't always seem as certain when you're up there. It's not supposed to. All right. So when we're up on what ended up being the highs of the day, these 90s, what are the five? It's not necessarily five tools, but there was a lot of confluence that happened up there that just gave it a chance for people who were bearish to get short, for people who were long to cover. And it wasn't, I don't like to come in here and tell people, got to get short, you got to get short. But when you're up there telling people, hey, if you're bearish, you could take a shot up here. If you're long, you should cover some or all, based on what we've seen here, instead of waiting to down here or down here, because then it's way too late, obviously. A fifth grader could tell you it's bearish when it's down in here. They sell it here, and then they cry to mommy there, then it goes down. But point is, in real time, what was up there to at least call a temporary high? You don't have to say it's going to be the high for the day. It's too much pressure on yourself. Don't try to call highs and lows for the day. Temporary highs and lows. If they turn out to be the high of the day, great, but don't try to call it, because what you do is you stay bearish for the whole day, and maybe you should and maybe you shouldn't. Like this pullback here against the grain. So this is the sell-off, and this is a retracement. But even before it got all the way up to here, we were talking about how it's not going to be as bearish anymore because this is rallied too much. It was right here. It's rallied too much in here at this point, and it had a chance to go lower in here, but it didn't. And so people, after they're too late trying to get short, they see it go down, sideways, follow through, go up, follow through, and then they want to play it. So this is the retracement. They try to sell it in here, and it doesn't follow through, even though it did here, and it did here, and it did here. It's just not going to continue to work. That pattern is not going to continue to work. And so you get so many people loaded up short, and they just chase each other, and creates a retracement that's way too high. And even though it might come back lower and get weak, it's just going to take longer because you got too many people on the team, you got too many people short. But let's get back into the highlight. What the hell was going on in here? First thing, we had a divergence. What does the divergence mean? It means the NASDAQ was strong and the ES was strong after the open, but the Russell and the Dow were weak. So it was maybe invalidating continued strength. That's number one. You had some weakness in these two of the stock index complex. Remember, you don't have to trade the NASDAQ and the Russell and the Dow to watch them. You should be watching them. If you trade any one of these, you should be watching the others. So you had a divergence in strength and weakness. Then you had a divergence between the NASDAQ and even the ES. What do I mean by that? The NASDAQ went up, made a higher high. So did the ES. But then the ES made a higher high. Let's draw it over here. The NASDAQ makes a higher high. So does the ES. Then the NASDAQ comes off and does this, and the ES does that. So the ES went through their high, but the NASDAQ couldn't. So that's showing you a divergence between the two strong markets. All right. ES was strong. NASDAQ was showing some weakness. Could the S&P be what is called expensive? Maybe. And you start to build this case and build this scenario. Now, another thing happened, and you don't see it on this chart, but in our puke indicator, what do you want to see? Who do you want to see puke in order to get short? You want to see other shorts puke, because you don't want a lot of shorts if you're looking to get short. That actually happened at around 89, 90 even as well. You don't see it on this chart because it happens in real time. Then the other thing, which was really the first thing that happened, we talked about in the pre-market, is that over 60% of the people in the poll that we do in the morning were bullish. And it's not about what you are before the market opens and how it ends up. It's knowing that we can adjust after the game starts. If you're bullish and it's something like this, you actually could make a lot of money being bullish, and you end up getting short, and that's where you made your money. Why? Because we have the ability to change our mind. Most people don't. So I take the poll to see if we ever get above 60% bearish or bullish. And we were at 62% bullish this morning, which is normal. You really should have been bullish. What it shows us is most of the rest of the market is probably that bullish, which is fine. It might work. It might go up. But if you ever get some sell-off like you did right here, it becomes a surprise. And not only is it a surprise because it moved down pretty quickly, but it surprised a lot of people. So it's a surprise, and there was a lot of people at the party. What I mean by that is a lot of people were at the party, meaning a lot of people were long because a lot of people were bullish, and they were getting loaded up. And so that's when you get a reversal, or you can get an extended move, in this case down, because people were coming into today's market loaded up with a bullish idea, which means they're looking to get long. They probably got longer. And the more longs you get, the more sellers you create. The more sellers you create, if it doesn't go up, those sellers become a self-fulfilling prophecy and move us lower. So just remember that. If most of the world is bullish and we have a decent break at some point early, you got a lot of people shocked, surprised, caught, stuck, and you could often have that. This isn't something that's useful if you say that here or here, but if you say it before the day starts, and you certainly say it like we did in here, be careful being long because we're going to get some extended downside just based on lining up all those things. We lined up all those things at 89.90. I just walked you through with a divergence between markets, divergence between 4 markets and then 2 markets. You've seen shorts puke up there. You have the opportunity to have a lot of people bullish and wrong. And so all those things lined up. Now, here's what's key, really important about this video. And I think people will really, it'll resonate. And I said it during the room, and a lot of people reacted to it. In real time, we often think that in order to be great, in order to be professional, we have to be very confident. And if we get short, we're confident it's going down. If we get long, we're confident it's going up. Nothing is further from the truth. The reason why is because in trading, you have to manage your risk, which means you have to know where you're going to get out before you get in. One of the first things I learned in the 1990s. Know where you're going to get out for a loser before you get in. You start managing your risk before you take it. So if you could assume that you're wrong or have a good chance of being wrong, how are you truly going to get confident? Where in real time, you're working on where you're wrong at, so you're not surprised. So it's hard to be really confident that price is always going to do what you think it's going to do. In fact, if you were able to document all the times you're confident, those are times the trades don't work. And then the times that you're really not sure, but you put it on, it was an effortless winner. And the thing is because and if you're a master at managing your risk, you're always assuming I could be wrong. There's a chance I'm wrong. There's maybe a good chance I'm wrong. It's hard to be very confident when you add that, and you should add that to your scenario, to your strategy. Now, that doesn't mean you can't be confident. Confidence comes from the ability to make sure you could stay objective and make the right decisions, even when you're wrong. That's what's confidence. Confidence in yourself, that you know how to handle yourself. You don't want things to go wrong in a fight. That's why if you know how to fight, you'll avoid them. But if push comes to shove, you know how to handle yourself. You're confident in the outcome. The point is that even though things could go wrong, you're confident in the decisions you're going to make when the you know what hits the fan. Doing what you say you're going to do during the trade from before the trade. Not moving your stop, not changing your mind, not adding to losers, not doing all the things that cause a big disaster. And it all started with one stupid idea. Confidence comes with the fact that you could do what you say you're going to do, that you trust yourself, that you have that discipline. And then what is discipline? Discipline is just, makes it harder to have discipline when we try to focus and define it. Discipline is just building momentum and doing what you say you're going to do. And at least not doing the opposite. because then you go the wrong way. So that's where I think a lot of people confuse, especially in the early years, months of trading, is they think that confidence comes from, when I buy it, I know it's going to go up and I'm confident it's going to rally. No, they're confident that they're going to be able to make objective decisions and not really trade their emotions when they're wrong, because they're going to be wrong. That's where the confidence is. There are times that you're going to be very confident in direction, but those are few and far between. Those are like some big news event hits. It could be God forbid, a catastrophe or something that happens on the extreme level, and you just sell it or buy it depending on what the story was, and you're confident in direction, right? And so that is, again, skill, and that's something you should know how to do. If something really bad happened, hey, that's bad, but that doesn't mean you sit and say, I feel sorry for everything that happened. There's time to do that. You have a job to do. Trade the movement of price. And if something happens, it's really going to move price, you have a job to trade. But that's when you're only going to be, that's the times you're going to be very confident that the market's going to go up or down. So just make sure you're using and understanding the word confidence and context in this business and in this industry. But again, the highlight comes back to not trying to pick or top or bottom, just trying to say, hey, some things are lining up to be less bullish and more bearish, to get short if you were otherwise bearish for another reason, to cover along if you were indeed long, to lighten up, but understanding it in real time, because it's easier to say it was going to be bearish and 90s were going to be a temporary high once we're down here. Fifth grader could see that, and down in here. In fact, they try to sell the retracements and keep getting stuck, and they're so mad that the pattern of this didn't continue forever. That's why it doesn't continue forever. Too many people start that. We had a summer market yesterday and a few days last week, and we kind of broke that a little bit with a nice couple moves, and we kind of floated back into it. So keep yourself safe, and just remember to watch this video again. I went a little longer today because there's a lot of things that happen that is worth remembering.